Hi there, and welcome to the Stock Market Starters YouTube channel. Today, I want to talk about when it's best not to take a trade. So, for those of you who know me, um, I love taking trades, right? I'm trading, I'm investing every single week. I make a new list of stocks to watch for trades. I'm in long term investments 24/7, basically. There's maybe, 1 or 2 days out of the whole year that I'm not actually in the market, especially in uptrends. But I love trading. I love investing. I make money while I sleep through this stuff. Like I do this. This is part of what I do. But sometimes it's best not to be in a trade, even if you have a good setup. Let me explain what I mean. So in trading, people a lot of times think, hey, stock trading, I can't do this, I can't do that stuff because it's too risky. And the truth is that there is some level of risk in stock trading, right? I talk about that in my courses. I talk about it in my videos. I talk about it on here a lot, right? There is risk in the market. And in order to be a good and successful trader, you simply have to learn how to manage that risk and to deal with it in the right way. And part of dealing with risk sometimes means managing how much of your account is in cash versus how much is actually in the market. So this week, for example, I was looking at, I don't know, 5 or 6 trades as I usually do on my, trading watch list for the week. And I ended up getting into two, but there was another one, a third one that had a really, really good setup. That ended up not taking the setup simply because I wanted to manage the risk that I had in the market. So, I was in two trades. The market was kind of all over the place. First, it was down big, then it was up big, and it kind of, it was stuck underneath like a shelf level for a while. It finally broke out later in the week. But at the time I was looking at this particular entry, the market was kind of all over the place, making big, wild moves. I was already in a couple of positions, and I didn't want to take on a whole lot more risk. And so, because I didn't want to take on more risk, I decided to keep more cash in my account instead of trading, even though I had a good setup. So, let me see if I can share my screen. I'll show you guys what that setup looked like, and then you can kind of follow along with what actually happened here. So the stock I'm looking at here is TTD. It's the trade desk. It's one I've been watching this week, and it was in a really nice uptrend, right? You can see bouncing up, pulling back, bouncing up, pulling back. And this day on the far right edge of the screen is when I was first looking at this stock. So, right, it was looking like well, actually, I first looked at it like back here, but when I was looking at it for a potential entry was this day, and it looked really good, right? I mean, I hopped on my daily stock talk videos. I talked about how, hey, like if it can break above here, that's looking pretty good. A nice move above these EMAs, this 5-day here and 10-day here. So what those colored lines are called EMAs, it's exponential moving averages. But a move above there makes for a really good potential entry. And so I looked at it and I thought, man, this looks really cool. But the market's all over the place, right? The market's moving in weird ways. I don't have all that much confidence in where the overall market is going. And I talk a lot about, right, the overall market. The reason I look at the S&P and think about this so much is because it's kind of like the tide, right? When the tide goes up, all the ships on the ocean will rise with it. But when the tide goes down, also all the ships will kind of sink with it. And stocks are very much similar to that, where if the overall market's going up, right, most stocks, not every stock, but a lot of stocks will follow the market and they will trend with it. They'll do different things, right? But when the market drops, then a lot of stocks will drop with it. And there's actually a technical term for that in financial analysis. It's called beta, and it basically looks at, okay, if the market moves $1, how much does your stock move? So maybe it's 50 cents, maybe it's 60 cents, maybe it's 70 cents. But it basically measures the correlation between those two. And it simply proves out the idea that, right, the stock market is like the tide. Stocks move with the overall market, and following the S&P and seeing that is kind of how you track what happens with your tide with the overall market. So the market was looking weird going into this stock. And I looked at it and I thought, man, this looks good. I've got it. Like I could buy this, but my account right now, right? This is an example account. I put in roughly like $50 every couple of weeks, and I've missed a couple weeks here and there, but generally that's kind of the deal. And I just consistently invest into it and go, okay, this is a trading account. Here's what we're doing. Here's what we're doing. Here's what we're doing, and we walk through and make this stuff happen. But it's a pretty small account right now, right? I haven't been doing this for all that long. Um, so the thing about it is I didn't want to take a lot of risk, and I already was in a couple of trades. I didn't want to overexpose my account, so I said, all right, I can't get into the trade. And what's interesting is, right, the trade moved up. So this is something that I want to point out simply because a lot of people, especially when they're just getting started, will really kick themselves over this. They'll be super upset about it and say, "Yeah, man, I could have gotten that trade, right? It was a good setup. I had it. I looked at it. I analyzed what it would actually look like to take the trade. I knew how much money I could spend, and look how much I could have made. Like, right, it's moving the right direction. I should have gotten in." And the truth is, that's beneficial to an extent. But if you have a good reason not to get in, like I did in this example, where I didn't want to overexpose my account with the market acting weird, then it's a good thing not to take a trade. So anyway, since then the market has moved up and made all-time highs here. It made all-time highs here. On this stock, it was moving up, but the overall market these 2 days made all-time highs again. And then today it's down a little bit, still well within its trend. If it pulled back here into the 10-day, by the end of the day today, maybe coming into next week, that could be a new entry. But I wanted to kind of hop on here, just show you guys sometimes it's best not to take a trade, even with a good setup, because managing how much money you have in your account in cash versus in stocks helps you manage risk, especially when the overall market or particular stocks are looking a little weird and you're not really sure where they're going to go. So, quick little video today, but I want to hop on, talk about that. And you guys, if you want to learn more about this stuff, if you want to learn how to actually get started in the market, learn things about, hey, there's risk, but here's how we manage it. And what is, TTD? I mentioned that at the beginning, right? The trade desk, it's TTD. That's called a ticker symbol, right? What does that mean? How do you draw these trend lines? How do you actually find the right stocks and look at this type of stuff? If you want to learn how to do that, I have a course. It's on the link in, I think it's my account information here on YouTube. But right, go check it out. It's stockmarketstarters.com and figure out how you can get started in the stock market for yourself.